What's going on, goats? Welcome back to BooKoo Bucks. My name is Raymo, and today will be day 4 of the ICT speedrun. If you guys don't know what this is me basically breaking down 275 hours worth of ICT content down into 31 days and 31 videos. So today, day 4 is going to be core content, month 3, all parts. And shout out to Lumini Traders for helping me create this roadmap. In case you guys do want to see exactly where these videos are within ICT's channel, everything is color coordinated, and I did show exactly where I did find these videos on the channel, like I said. So let's go ahead and jump into day 4 notes. Day 4, month 3, time frame selection and defining setups. Time frame selection, monthly charts, position trading, weekly charts, swing trading, daily charts, short term trading, recommended to start here, and 4 hours or less day trading. So all what this is saying here is if you are trying to be a swing trader, you'll most likely want to look at the weekly charts. If you're trying to be a day trader, you'll want to be on the 4 hour or less. And what he recommends is to try short-term trading, which will be utilizing the daily charts. Defining setups for your model. Trend trader, trading only in the direction of the monthly and weekly chart direction. Swing trader, trading the daily chart intermediate price or intermediate term price action. Contrarian trader, trading reversal patterns at market extremes. Short term trader, trading the weekly ranges for 1 to 5 days in duration. Day trader, intraday swing trading with exits by 2 p.m. EST. So, what he's saying here is if you're trying to be a trend trader, then you'll only go in the direction of the monthly and weekly. If you're going to be a contrarian trader or just a reversal trader, you'll be taking the reversal patterns. And if you're a day trader, you'll be looking at intraday swing trading and all that good stuff. The style or time frame selection you choose will be completely up to you. It may depend on your personality and or the time you have available to give to the charts. So for example, if you are a trader that does not want to spend much time on the charts per day, then most likely you'll want to hold trades for a long period of time as it does not require a lot of time for you to be looking at the charts. But if you have a lot more time in your day and you want to actively be in and out of the market, then most likely it's going to take a bit more time to be on the charts each and every day, and most likely you'll want to be more of a day trader. So, like I said here, or like he said, it's going to be completely up to potentially how much time you have to give to the charts and also your personality and the type of risk taker you are. Monthly chart, the long term price action reference for the largest price action swings in trading. Trading setups take a great amount of time to form, but when they unfold, they tend to unfold over many months. Due to the length of the time this chart requires to present a setup, trading the direction of the most recent setup can yield low risk and high reward conditions. Swing can be several hundreds of pips. In the images below, with the understanding of the monthly time frame, we can use the concepts we already understand to predict where price is most likely to go. This will take a long time to play out, but it will help especially when trying to identify where the lower time frames are likely to go. So ICT is basically describing that if you're using a monthly chart, this is a great way to predict long-term price predictions on what price is going to do, but it is going to take a long time to play out. Remember, if you're on the monthly chart, it is going to take 1 month for even one candlestick to form. So obviously, if it is going to, like here, make a new lower low, this could take several months, maybe even up to a year. But at the same time, these swing moves can generate hundreds of pips. And I did not break down these images just yet, but he's showing here as price pushed on down. This will be a nice order block that most likely price will want to come up into. Where you see here, where would price likely trade to next? So once price came up here, where is it likely to go? Well, most likely after tapping into the order block, it's going to want to continue to go lower and make a new low. What's under here? Sell side liquidity. So most likely the banks will want to target that sell side liquidity. So if we have this higher time frame setup on the monthly chart, we can look to short here and maybe scale in on a lower time frame to take these shorts. But again, it will take a long time to play out. But we can see that if, especially if we go down to a lower time frame and refine the entry and refine our stop loss, this could generate a low risk setup with a high reward opportunity. Weekly chart, the intermediate term price action reference for the intermediate price action swings in trading. Trading setups can take some time to form on this time frame, but when they unfold, they tend to unfold over many weeks. Due to the length of time this chart requires to present a setup, trading in the direction of the most recent setup can yield low risk and high reward conditions. Swings can be several hundreds of pips over an intermediate period of time. With the understanding of the higher time frame, we can use bearish setups to look for shorts on the weekly time frame. So this is basically the exact same thing we just went over, except we're transposing the exact same ideas and concepts down to the weekly chart. The only difference is if we go to the monthly time frame again, we understood that most likely once price tap this order block, we anticipate price to push on lower and make a new lower low. So we can go down to the weekly time frame, and with the idea of the monthly time frame to make a new low, we can use the weekly time frame to look for shorting opportunities and anticipate price to make that new low. Now we aren't using the monthly time frame to find these setups, we're using the weekly time frame. So once again, we're going down to a lower time frame to refine the setups. But ultimately, this will still take quite some time to play out, not as long as the monthly time frame, because obviously that is a higher time frame. It's going to take a lot more time to play out. But utilizing the weekly time frame, we could potentially refine our setups and potentially hold for a couple weeks rather than months. Daily chart, the short term price action reference for the short term price action swings in trading. Trading setups take a little time to form on this time frame, but when they unfold, they tend to unfold over 1 to 3 weeks. Due to the length of time this chart requires to present a setup, trading the direction of the most recent setup can yield low risk and high reward conditions. Swing can be 50 to 300 pips over a short period of time. Using the higher time frames, monthly and weekly, we can look for bearish opportunities to take shorts, turtle soups, order blocks, etc. What you use to find your entry will be up to you and what you like. So same exact thing. We're just going down to a lower time frame, utilizing daily time frame to find these shorting opportunities. We're utilizing the fact that the weekly and the monthly are bearish, and so we can look for these shorting opportunities on the daily time frame. Now, if we use a daily time frame, it may take several days to play out, or a couple weeks, as he said here, 1 to 3 weeks, but it's not going to take months on end. So this is the exact same thing we just went over, except going down to a lower time frame. If the weekly and the monthly are bearish, we could utilize the daily time frame to find these bearish setups. Now, since we're on the daily chart rather than the weekly or monthly, these setups will not take as long. Technically, they will take long if you are holding for 1 to 3 weeks, but they won't take as long, for example, waiting months on end for price to play out. So once again, it's just utilizing all the time frames together, going down to a lower time frame to refine our entries and take those shorting opportunities. He also points out here there are different methods and POIs we can use to take the shorts, but what you will decide to use will be completely up to you. Grading swings refers to making up the quarter points of an anticipated move before it happens. If you use the previous leg, you can predict the amount of movement the next leg of price is going to be. From there, mark up the quarters of it, and you can most likely find a setup in these areas. So, what I believe he is saying there is just like in the other lesson, we can potentially predict how far price will move before it does based on the previous leg of structure. So, right here, we can see how price falls down and makes a new low as we anticipated. But even before price made a new low, we can go ahead and use this swing high down to this swing low, track the pips, track the points, and then transpose it to where we think the next leg is going to form. Meaning, once we anticipate price to drop lower, yes, we anticipated price to drop lower because price tapped into that monthly order block. So once we anticipate that, we can kind of anticipate how far price is most likely going to go by utilizing this first swing move here. So if we can anticipate that, I believe what he is saying here is when we mark up that range, we could mark up the quarter points of that range, meaning 25%, 50%, 75, and then 100% of the move. And usually at these quarter points, we can find shorting opportunities of some sort. So here we can see price shorted from this first quarter point, price shorted here from this second quarter point. It looks like this might be the tap of the third to push on lower, and then last but not least, that fourth point that continues to push on lower. Month 3 institutional order flow. Thinking like the market efficiency paradigm. You are the market maker. What you are looking for is where the maximum level of liquidity in relationship to where markets have traded from and where they are presently. Typically, this will be in the form of price coming to mitigate an order block or fill voids to rebalance the market and seek the next level of liquidity. When price comes into your POI, most likely there will be an extra run on liquidity before pushing in the direction. Usually, it runs a tad bit higher or lower than you anticipate to take out the last bit of liquidity. So basically, we have to think like the algorithm. What does it want to do? Well, it wants to mitigate order blocks and fill voids and seek out liquidity. So, for example, here we have this swing high, down a swing low. Why does price come back on up? One, to fill the voids up here, and also to tap in the order block that we had shown before. Sometimes he does draw an order block based off the wicks. He really hasn't broken that down in detail just yet, but technically he is utilizing this as a form of an order block. And if you notice, as price comes into the order block, if we zoom in very close, this wick high gets swept before pushing lower. So this is where he's describing that usually price will get close to your POI, and right before it, price may want to run that last bit of liquidity, in this case buy side liquidity, before pushing in your direction. Now we have a new swing low to a new swing high. We anticipate price to come on up to fill voids and also tap into this order block. Once again, he does draw this order block slightly different. And then once again, we can see how this wick high gets swept, the last bit of buy side liquidity being swept before price pushes on lower. Institutional order flow. Institutional volume is under the bodies of the candles. The wick is always related to retail. So here, why does price not go lower? He is describing how price is basically tapping into the institutional volume, which is going to be based off the candle body closure and not the wicks. I will state that this is kind of as of right now a little difficult to understand, because how do I know when price will run the low versus just simply tap into the closure of the candle? I'm not too sure, but for now, let's just understand that he is describing institutional volume is under the bodies of the candle, not the wicks, and the wick is going to be related to retail. You can also use this same concept for order blocks. Watch to see if price closes within it. Just because a wick breaks it does not mean the order block was not respected. So here he draws up some form of an order block based off the wicks, I'm assuming, and he's describing that even though price wicks underneath it does not mean it was disrespected. Watch to see if price closes underneath or not. In this case, price does not close underneath, so he would actually consider this being a respected order block. With the understanding of the higher time frame and where price is most likely to go, we can anticipate institutional order flow on the lower time frames to do its things to reach the objectives. Red equals bearish order flow, and blue equals bullish order flow. So what he is showing here is that as price goes bearish and pulls back on up, the only way price can pull back on up is if price is in bullish order flow. So bullish order flow has to occur to bring price back on up to the POIs that we just described. Now, in order for price to push on lower and make new lows, price has to reverse, of course. So bearish order flow has to come into play. So with this understanding of bullish order flow taking price higher and bearish order flow taking price on lower, if we understand what is most likely going to happen, and also, if we can go down to a lower time frame, which we will get down into here very soon, if we can go down to a lower time frame to see price switching order flow, we can kind of use those two things in correlation to figure out what is a high probability setup. We can identify when order flow is switching on the lower time frames and ride them up and down. So, for example, as we anticipate price to pull on up into this POI, we can go down to a lower time frame to find the bullish order flow to take longs to the upside. As we get up into the POI, we can go down to lower time frame to wait for price to show us bearish order flow so we can take shorts to the downside. So here we have a bearish order flow switch, and then we can look for shorts to the downside. Same thing, bullish order flow, then bearish order flow. Once we see price flip bullish, we can take longs. Flip bearish, we can take shorts. Month 3, institutional sponsorship. Institutional sponsorship in long setups. Higher time frame price displacement. Reversals, expansion, or return to fair value. Intermediate term imbalance in price. Move to discount or sell side liquidity run. Short term buy liquidity above the market. Ideal for pairing long exits to sell to. Time of day influence, for example, London open, low of day, or New York low formation. So all he is saying here is that when price does one of these things, it is going to be a great opportunity to look for longs because institutions are sponsoring these long setups in those situations. Institutional sponsorship in short setups, higher time frame price displacement, reversals, expansion, or return to fair value, intermediate term imbalance in price, move to premium or buy side liquidity run, short term sell liquidity below the market, ideal for pairing short exits to buy from, and time of day influence, for example, London open high of day or New York high formation. So exact same thing as the one before, but in this case, the inverse. If you see price doing one of these things, this will actually be great to look for short setups because the institutions are sponsoring these short setups. Overall, it is the understanding of the higher time frame objectives or what it is most likely going to do to help create a bias on what the lower time frames are going to do. In the following example, you will see how price takes out sell side liquidity so you can anticipate a reversal from this area. If you anticipate a bullish move from here, you can use a bullish order block to take longs. As price progresses, you can see how price displaces higher, attacking liquidity in the form of wicks and the void. Before I do break down that example, we kind of already seen it in the previous slide. If we understand the higher time frame, we can transpose this idea or the higher time frame objectives to the lower time frame to understand what the lower time frames are most likely trying to do. So this is the daily chart shows price dropping down below an old low, where sell stops would typically be pulled. The aggressive trader can at that time look for lower time frames to show similar price action in the form of a low being violated and a long can be taken. So here what he is showing is that underneath this low, if you understand that there are sell stops resting underneath here, then once price runs these sell stops, most likely you can anticipate a reversal to the upside. So if you want to, you can go down to a lower time frame and be a bit more aggressive and take longs after price sweeps the low. And as price progresses, we can see after price takes out sell side liquidity, price creates a bullish order block. This is that last down move before price pushing up. So seeing this bullish order block and then seeing price take out sell side liquidity, you could technically look to long off of this bullish order block to the upside. And if you are looking to long to the upside, you can also use this liquidity void as a potential target as you anticipate price to fill this area before either continuing to the upside or even reversing from here. Down here, we have displacement, clear indication that a large entity is entering the marketplace. Price gives an explosive move that only big money can do. So as you can see, price moves heavily to the upside very fast and very quick, or in other words, explosively. So when you see this, this is called displacement. The only way this can happen is if big money is in the market. They are the ones that are moving price so hard and fast. So when we see this, this is a good sign that the banks are present in this area and most likely going to move further to the upside. To identify institutional sponsorship in a particular segment of price action, you need to see immediate dynamic response. If it is lethargic or not willing to move, that means there is no institutional order in that area. If you are in a trade during this time, the first thing you should be thinking is to either reduce risk or bail the trade. When price is at equilibrium relative to the overall objective, buy sell liquidity at the old high, and the origin of the initial push, price is most likely not going to pull back to a deep order block. So basically, here, what he is showing is that once price comes in and taps the sell side liquidity, if the banks are truly present in this area and are going to push price to the upside, it should happen relatively quickly. Price should not be lethargic or moving slow, because if it is moving slow, that is showing us that the banks are not present in this area, and we might want to bail the trade or even reduce the risk on the trade if we are in that specific trade or in a trade at that specific time. So if we see the big bullish move, that is a good sign. If price is moving slow, not a good sign, and we might want to reduce our risk. So for this second part, I might need to do some more back testing and research to really understand what he is saying. But the main gist of what I got here is that when price is at equilibrium relative to the overall push, then most likely price is not going to pull back. So what I mean by this is once price gives us that displacement to the upside, price pulls back to the origin of that push, meaning where the push began, where this big displacement move came into play. Now, once price pushes on higher, we are generally speaking, about 50% above the overall push, meaning from this low up to this high where we anticipate price to go, because we anticipate price to make a new high. If price is above the 50%, most likely after price takes out this buy side liquidity, price is most likely not going to come all the way back down to the origin of the push before pushing on higher. Very similar to here. Price gives us a push, price comes back to the origin and pushes on higher. Once price is above equilibrium and taking out buy side liquidity to the left, it probably isn't the best idea to anticipate price to come all the way back down to the origin since price is above the 50% of the overall push. If that didn't make sense, I'll try to reword it. When I talk about the 50%, I am using the origin of the push, which is somewhere down here, and then where we anticipate price to go. So from this low up to the side, the 50% of that move, if you see price above the 50%, most likely price is not going to give us a deep pullback as we did here. Most likely price will take out buy sell liquidity as it does here and maybe give us a slight reversal, but anticipating a deep reversal is most likely not going to happen. Each time price takes out a level of buy sell liquidity, we don't collapse the trade entirely. We don't look for reversal patterns. We don't look for divergence and indicators every time we get to an old high. We are looking for willingness to keep moving higher to run these longer term buy stops. Do not fall for the reversals. Do not fall for the reversals because most likely price will not actually reverse. Instead, it will target the overall objective old high first. So what he is showing here is when price takes out buy sell liquidity, as we kind of described over here. Once we take out buy sell liquidity, we really aren't looking for reversals. Not to say price can't reverse, but ultimately we anticipate price to continue to go higher. Also, seeing that price is above the 50%, we really don't anticipate price to give us a steep pullback as we just described. So we really wouldn't want to look for shorts. Doesn't mean you can't look for shorts. We just have to be really aware of what we are getting ourselves into. And most likely it's going to be a very short term trade. And if anything, we want to avoid these because they are higher risk setups and then continue looking for longs. And hopefully, in the case that we do take longs down here or even longs down here, once price takes out buy sell liquidity, he is recommending that we don't actually collapse the entire position because we should anticipate price to continue to go higher if our overall objective is still correct. So here we can see price takes out buy sell liquidity. People may be potentially looking for shorts, but again, we anticipate price to run this old high. So we would want to hold our position up into new highs as we can see right here. Midnight open. If we expect price to go bullish, we can look at the opening price at midnight in New York. What we see in the form of institutional sponsorship is when it goes below the opening, price should be accumulated. In other words, we want to buy below the midnight open as price accumulates there. Watching how this develops at old highs can help you determine if price will reverse. So what he is showing here is if we have a bullish analysis or a bullish prediction, as we've been going over on these charts over here, if we anticipate price to keep going higher, once midnight opens, we want to look for long setups underneath the 50%. Sorry, not the 50%, the midnight open. So right here, this is the midnight open at 12 a.m. EST. If price is underneath, this will be prime areas to look for longs. If price gets underneath, this will be prime areas to look for longs underneath, prime areas to look for longs, and so on and so forth. We can also utilize this to help us determine if we want to take short setups, even though we kind of just went over that we don't really want to because the higher time frame is bullish. But I say this because potentially price may reverse for a short amount of time before pushing on higher. If so, we could look for short setups, but we can also watch how the midnight open plays a role in these areas. So, for example, price takes out an old high here. Are we going to look for shorts? Is price going to reverse? Well, let's see how price reacts at the midnight open. Price gets underneath and continues to push on higher. So when we see this, we understand that price is now reversing and we could utilize this to continue our bullish bias. So for this one, to be honest, I did not completely understand this video. If I do understand it in the future, I will go ahead and add more notes to it. But like I said, I didn't really understand it, nor did I feel like it was super important. Month 3, institutional market structure. What is institutional market structure? The analysis of correlated assets or the relationship to inversely correlated assets. The purpose is to determine what the smart money is accumulating or distributing. Currencies are easy to analyze with institutional market structure with USDX, and every price swing should be studied to determine if market symmetry confirms it. How do we identify institutional market structure in Forex? Compare every price swing in the USDX with the foreign currency you trade. As USDX trades higher, expect a lower price swing in foreign currency pairs. If USDX or a foreign currency fails to move symmetrically, smart money is actively trading. As USDX trades lower, expect a higher price swing in foreign currency pairs. And if USDX or a foreign currency fails to move symmetrically, smart money is actively trading. So we'll break these down more in detail very soon. Institutional market structure, USDX, SMT divergence. In symmetrical market conditions, when the USDX makes a lower low, foreign currency makes a higher high. This confirms current price action and the underlying trend is likely to continue. The idea of stalking reversal patterns in this condition is not high probability and should be avoided. When the USDX makes a higher high, foreign currency makes a lower low. This confirms current price action and the underlying trend is likely to continue. The idea of stalking reversal patterns in this condition is not high probability and should be avoided. So to try to simplify this a bit more, if we can see that the US dollar is printing lower lows and say EU is printing higher highs, most likely EU is going to continue this bullish price action or this bullish trend because the US dollar is losing strength. If the US dollar is continuing to drop, most likely that'll cause EU to continue to ride on higher. So once again, if we see this type of symmetry in the market, most likely EU is going to continue to push on higher. Now, this is the exact same thing, but flipped around. We can see the currency, EU, is making lower lows, and then we see the US dollar is making higher highs, meaning the US dollar is gaining strength. If the US dollar is gaining strength and we can see EU is falling on lower, most likely EU is going to continue to fall on lower. And that's why we can see here, most likely the underlying trend is likely to continue. And in these two cases, if you're looking for any type of reversal patterns, it is not going to be a high probability setup, and most likely you want to avoid it. Institutional market structure, USDX, and SMT divergence in non symmetrical market conditions. When the USDX makes a lower low, foreign currency fails to trade higher than a previous high. This is USDX SMT. This does not confirm current price action, and the underlying trend is likely to continue. The idea of stalking reversal patterns in this condition is high probability and could be considered. When the USDX fails to make a higher high, foreign currency makes a lower low. This does not confirm current price action, and the underlying trend is likely not to continue. The idea of stalking reversal patterns in this condition is high probability and could be considered. So to simplify this one up as well, this is the exact same thing but flipped. Here we can see the US dollar is making lower lows, and we can see that our currency pair, for example, EU, is making a lower high. When we see this, and the US dollar is going to most likely continue to drop, meaning lose strength or gain weakness, however you want to look at it. If we understand that the US dollar is going to continue to drop, and we can see that the foreign currency is not making higher highs, this is most likely going to cause the currency to reverse its trend. Same thing here if the currency is making lower lows, but we see the US dollar is making lower highs. This is going to cause the currency pair to reverse trends, most likely, I should say. It's not a guarantee. But if we see the US dollar continuing to drop or showing the willingness to continue to drop, showing signs of weakness, then most likely the currency pair is going to reverse. So if we can see this type of divergence, we have non-symmetrical market conditions, then we can utilize this to potentially look for reversal patterns because in this situation, this will be considered high probability setups. To simplify everything, use a DXY to help with currency pairs that have USD in them. For example, GBP USD. If we are trading GBP USD and we see it as bullish by creating higher highs and higher lows, but USDX is also creating higher lows and higher highs, we have to understand that the strength of the US dollar is increasing and should cause GBP USD to go down. If we see this happen, we can potentially anticipate GBP USD to go bearish as DXY is giving us the clue before it does. In the images below, we can see that GU was bullish as it created a new higher high, but USDX just created a new higher low. This would have given us a clue that GU was just manipulating buy stops to go lower. So right here, we can see on GU on the daily time frame, price actually runs to the upside, making a higher high. Now, without seeing all this price action here, seeing the bearish drop, if we delete that, most likely from a retail trading perspective, we would anticipate price to pull back, make a higher low, and make a higher high, as this looks very bullish. But going to the DXY and looking at the strength of the US dollar on the daily time frame, we can see how the DXY just made a higher low. So if we understand that DXY just made a higher low, that means that most likely the dollar is gaining strength. Now, if the dollar is gaining strength, that most likely means GU is going to fall. So even when price made a higher high and based off structure, it looked like price was going to continue to push on higher, DXY already gave us a clue that most likely GU was just manipulating the buy stops above these highs to then push on lower. Month 3, macroeconomic to micro technical. Interest rates can help with looking for a long term macro view. It can give a 3 to 6 month outlook on where currencies may be heading. You can find interest rates by looking at the bond market. The 30-year treasury market will give the insights to this. Every 3 to 4 months, there is a quarterly shift that takes place. Whatever trend or market condition it is in, there is usually a shift around the 3 to 4 month mark. If interest rates are going higher, then the USDX should also go higher. If the bond market is going lower, then the interest rates should go higher. Treasury bonds and interest rates are inversely correlated. So basically, if you really do want to go above and beyond, you can actually look at the treasury bonds and interest rates as they are inversely correlated. Meaning, if we see here that the treasury bonds are falling lower, most likely the interest rates are going higher. And if we can predict that interest rates are going higher, most likely the strength of the US dollar would also go higher. So we can kind of back up the strength of the US dollar with the treasury bonds and the interest market to then hopefully correlate to our currency pairs as well. Month 3, market maker trap, trendline phantoms, diagonal trendline support. The market begins to make higher highs and higher lows. The market appears to have an imaginary diagonal line it seems to repel price higher from. Retail traders will extend these imaginary lines into the future and attribute support theories to it. When price hits the extended imaginary diagonal line connecting higher lows, retail buys then. Diagonal trendline resistance, the market begins to make lower highs and lower lows. The market appears to have an imaginary diagonal line it seems to repel price lower from. Retail traders will extend the imaginary lines into the future and attribute resistance theories to it. And when price hits the extended imaginary diagonal line, connecting lower highs, retail short then. So most of you guys already know what trend lines are, but if you don't, it's just simply drawing a diagonal line or right here an imaginary diagonal line because it's technically not on the chart. You are drawing it yourself. As you see here, price is forming higher lows. And you can see if you draw this line out, price touches it every single time. And the idea is, as a retail trader, whenever price touches this support level, we anticipate price to repel and push on higher. Now, with the downtrend, it's the exact same thing, but obviously price is going lower. We, as retail traders, or I shouldn't say we, because realistically we wouldn't be using it, but as a retail trader, people will be drawing this imaginary diagonal line of resistance, thinking that every time price taps this line of resistance, price will repel, and continue to drop on lower. Retail bullish trendline support, market maker trap sell scenario. In periods when price is making higher lows and higher highs, the use of trendline support will be adopted by retail traders. The influx of weak handed or less informed money at an area or price level provides liquidity for the market maker. The chart may appear bullish, but the underpinnings are in fact the opposite. The retail crowd will buy at a moment when price will be devoid of support. Price will collapse and leave the retail traders long with drawdown in the trade. You can potentially anticipate shorts after the third touch of the trend line. Now, as a retail trader, if they're seeing this and they're looking to long off of this trend line, what is going to be underneath the trend line? Well, their stop losses will be underneath, and therefore a stop loss in a long position is going to be sell stops. So the banks will actually understand this and understand that there is sell side liquidity resting underneath. So after a few touches, the banks will actually reverse price and target all of that liquidity for themselves. So with the understanding that the banks are doing this intentionally and they want to take out the sell side liquidity resting underneath, at some point they will reverse price and trigger all the sell stops resting underneath. And what he is saying here is potentially you can anticipate shorts after the third touch of the trend line. So here we have one touch, two touch, three touch. After the third touch, we could potentially use some type of POI to look for shorting opportunities to the downside. Now, this is the exact same thing, but flipped. As a retail trader, seeing that price is bouncing off of this trend line, retail traders will continue looking for shorts off of this trend line. If they're looking for shorts, where is a stop loss above the trend line? What is a stop loss in a short position? It is going to be a buy stop. So understanding that there are a lot of buy stops resting above the trend line, the banks will understand this and want to utilize this to their advantage and attack all of that liquidity. So usually after the third touch, price will run the trend line. We have one touch, two touch, three touch. Once price gives us that third touch, we probably don't anticipate price to continue to respect the trend line. We don't anticipate price to make a new low. We could potentially use some type of POI to anticipate price to run the trend line and attack all of the buy side liquidity. I also forgot to point out that in this case, this is tricking or trapping the retail traders. That's why it's called market maker trap buy scenario and market maker trap sell scenario. When looking at a live chart, you can utilize the understanding of the higher time frame to know what the lower time frame is most likely going to do. For example, if the higher time frame is expected to go lower, if you see a bullish trend line on the lower time frame, most likely price is not going to respect the trend line and fall lower. So this is very similar to the section when we went over the bullish and bearish flag patterns and understanding that most likely they're going to be traps depending on where they are relative to the higher time frame. So for example, right here, we see that price has tapped into this order block, price has filled the void on the higher time frame, and we probably anticipate price to push on lower and make new lows. But if we go down to a lower time frame, people may be trying to draw a trend line here where price gives a one touch, two touch, three touch, and they believe price will go higher. Now, although this could potentially happen, we understand that most likely this is not going to happen because we understand that most likely on the higher time frame, price wants to make a new low. So most likely price is going to run the sell side liquidity and push on lower. You can also see based on the way price pushes on down, meaning how explosive and fast it is, that is just showing us all of the sell stops getting triggered in this area, just as we anticipate all the retail traders trying to long from this area. Same thing here, we can kind of anticipate this bullish trend line forming here, but if we understand that there is sell side liquidity resting underneath, most likely the banks will want to sweep all that sell side liquidity rather than respect it and push on higher. Month 3, market maker trap head and shoulders pattern. Head and shoulders pattern, false top in price. Generally, price will form these genuinely at intermediate or long term highs. Due to the low understanding of most retail traders, they seek this classic topping pattern on lower time frames, many times at a significant low in price, but they marry the pattern. So here he is talking about a head and shoulders pattern from a retail trading perspective. You will have a left shoulder, you have a head and a right shoulder, and this will be the neckline. Once a retail trader sees the neckline being broken, they anticipate price to pull back to the neckline and then go short. So this pattern here is going to be a reversal pattern, meaning as we see here, price is going bullish, and this is a sign that price will go bearish, and they'll be looking for shorts. Inverted head and shoulders pattern, false bottom in price. Generally, price will form these genuinely at intermediate or long term lows. Due to the low understanding of most retail traders, they seek this classic bottom pattern on lower time frames, many times at a significant high in price, but they marry the pattern. Same thing, price goes bearish. We see a left shoulder, head shoulder, right shoulder. Once price breaks this neckline, they look at this as a reversal pattern, meaning price is going bearish. Now they anticipate price to go bullish. So once price breaks the neckline, they want to see a pullback to the next line, to the neckline, and then take longs to the upside. Head and shoulders pattern. When you see price break the neckline, you can actually use this as a way to enter a long, especially if the market is an institutional bullish environment, turtle soup longs. This move is usually a trap for all of the retail traders. So here on this specific example, we can see how this is a left shoulder, this is the right shoulder. My bad. This is the left shoulder, this is the head, and this is the right shoulder. And then price breaks the neckline. So from a retail trading perspective, they think that this is a sign that price is reversing and going short. But as you can see, price runs the sell stops and pushes on higher. So this is where that trap comes into play, where retail traders think it is a reversal to go short, but instead actually goes higher. And usually we can see that it won't go higher, especially if the higher time frame or the institutional bullish environment is actually, as it says, bullish. If the institutional environment is bullish, we don't really look for shorts because obviously we understand that most likely price is in bullish order flow, or the market is just simply bullish, to make it very simple. So yeah, there's that. And then inverted head and shoulders pattern. When you see price break above the neckline, you can use this as an opportunity to long, especially if the market is an institutional bearish environment. So to be honest, this is the example he gave. In my opinion, I think it is a bit of a stretch. It is a bit hard to see, but he is showing that this is a left shoulder, this is the head, this is the right shoulder, and this is the neckline. It's more of a dynamic neckline because obviously it isn't a straight line. It's more diagonal, more of that trend line look. So once price breaks above, potentially traders are actually looking too long because the neckline was broken, but instead it goes lower. Ultimately, the thing we want to see here is that if we understand that most likely price is going bearish for all the reasons that we have, if we see price give some type of inverted head and shoulders, we're actually not looking for longs because once again, the higher time frame or the overall objective is to go lower. And if we see this happen, once price breaks the neckline or takes out the buy side liquidity, we can actually look for shorts. And what he would call here is a turtle soup short. And we can look for shorts off of that buy sell liquidity sweep. Same thing here. If we understand that most likely price is just simply taking out sell stops to push on higher, then once price breaks that quote unquote neckline, we can actually utilize this as a sell side liquidity sweep to then look for longs to the upside. Rather than like the retail traders, they see price break lower, they look for shorts. We would actually be looking for the opposite, which would be looking for longs. So that is it for day 4. If you guys do want these notes for yourself, they will be available for free inside my WAP with the link in the bio. If you guys do have any comments or questions, please drop them down below. Thanks for watching, and I will catch you in the next one.